Hi, I'm Tracy Sorrell with the DFW Life, and I help people sell and buy homes in and around our Dallas-Fort Worth metroplex. And here's a conversation that I've had lately that I'm going to describe this as 3 myth busters. Number 1, based on the housing market, what's going on today, that there has got to be some kind of bubble, burst, or crash. Well, I hate to bust your bubble, but that's just not going to happen. That is a myth. The fact is that our sellers are a lot more savvy than they may have been in 2006, 7, and 8. So if you're waiting for that type of crash to happen, it's just not going to happen. Remember, that was a mortgage issue, not homeowner issue. And that leads me to myth number 2, and that is that homeowners now, because of the mortgage rates, have to be desperate and ready to give away their homes. Well, that's just not the case. Think about it this way. If you've been thinking about purchasing a home and you've noticed that home prices have gone up year after year, then that equals to appreciation for the homeowner. So that means they've got a lot of staying power. They don't have to give away their home. They can just ride this out until they get a great buyer who's willing to pay what they want for their home. And this leads me to myth number 3, just waiting until after the election. I get it, you're right. Sometimes things do change. The incumbent as well as opposition, they promise a lot of things that they're going to shake up and make better for the entire country. But then you are leaving someone else the power and the control to determine whether or not you move. Now, do you really want to risk someone else to decide whether or not it's time for you to move? But what I'm starting to hear more and more is that people are getting accustomed to the interest rates. They're not as low as they were, and they're not as high as they have been. So they've decided that I'm going to continue to live my life. So in this video, we're going to help you make that decision to continue to live your life and move to your next place. I have one of my expert mortgage partners here, and we're going to talk about some ways that you're going to be able to finance your home that you may not have even considered. In this video, we're going to educate, inspire, encourage, and help you think out of the box, whether you are a new homeowner or you're a veteran and you've bought and sold many homes. Even for you, there's some current, new, updated information that's going to help you make your decision and move to your next place. Are you ready? Well, Deanna, I'm so excited to have you today because Deanna is my mortgage expert in our Dallas-Fort Worth metroplex. And I have gotten so many questions, Deanna, from people who, well, let's face it, 2023, it was icy and dicey in our housing market, mostly because of the mortgage rates being astronomical, especially compared to what we were accustomed to. Because we got really spoiled by 3%, 4%, it's 5%. Oh my God, what's wrong with you? 5%? What happened to you? Yeah. You got to refinance. But
Absolutely.
now, but last year, did it get even as high as 8%?
It did.
So, I mean, that was like a showstopper for so many people. And you've been doing this, what, just a little bit. How long have you been?
Since 2005, since February of 2005. So I've been through a few of the markets, definitely for sure. I did want to say something about, the new norm, since you mentioned that. Over the last 40 years, historical average mortgage interest rates range from 6.5% to 7.5%.
Visiting with your mortgage advisor is your first step when it comes to purchasing your home. I know oftentimes you see home, you love home, you want to buy home, and you want to see 1,000 homes. Before you get too excited about buying the home, you have to slow down and get your mortgage situated. So what I want you to do, because I help newer buyers and also help seasoned veterans. I mean, they've been buying homes. They know what they want.
Right.
I do have a belief that you may have just a bit more knowledge than they do. So I know you're going to share some insight on, both on the new and the seasoned home buyers. And by new, isn't it true that new by definition is if you have not owned a home in the past 3 years, you are now considered a new home buyer if you decide to purchase?
Correct. You're a first-time home buyer.
So I'm just excited that you were able to come because you can see that I was ready with my questions, because I do have people ask about, Tracy, with the mortgage rates. First, we had a little tick downward, then it went back up. So even though we have a yo-yo and people like to time it when it's low, you may not be able to time it perfectly.
No.
But when it's your time to move, it's time for you to move. And so what we're doing is trying to inform, educate, help you think differently, maybe help you realize some things that you never even considered before.
The thing that is a little bit different with me too, I'm also a certified mortgage advisor. So being a certified mortgage advisor, I watch the bonds, I watch the market. I will tell you exactly when is a good time to float, which means not lock in the rate even after you're under contract, or lock it in as soon as possible. So I watch that market on a daily basis.
Oh, that's great. That's great. What are some practical ways that a person can increase their credit score?
So there are a lot of different ways. There are some, if you don't have any credit at all, but you have an apartment, let's say, and you have your rental history and your utilities, even a cell phone. There are some sites that you can go to have their payment history reported to the credit report, just to get that ball rolling. So it can be utilities, cell phones, and rent that you can actually report to the credit report to get that ball rolling. Then there's also secured credit cards and first-time user credit cards that you can do. What those secured cards mean is you have to put that money up. Let's just say it's $500, and you put your own deposit up on that credit card. Then they may keep that for a year or 2 years, and then you could move that to a regular credit card. But it's really important to keep that utilization down to at least 30% or below in order to start building your credit, at least when you're first getting started. But anytime you're trying to build your score and get your score increased, keep that utilization below 30% of the limit. So at $500 on that secured card, you never want to have your balance, ever want to have the balance go above 150, because when you do, that starts actually docking points. So one of the tricks that I tell people to do is to take that card, put up the tank of gas, put the card away, wait until the bill comes in, don't pay it off. Only pay the minimum payment due and wait for the second bill. When the second bill comes in, that's when you pay it off, and then on the third month, you'll do another tank of gas. What that shows is low utilization, good payment history, and it actually makes that score rocket, just because of those things. 30% of your score is actually revolving credit.
Speaking of credit cards, you mentioned that maybe for younger people, if the parent is willing to allow them to be a co-owner, how does that work?
Yeah, so you can also be an authorized user on a credit card. So if a parent is willing to do that, they can actually take a credit card that they already have, that they've had established for years, and add them as an authorized user. Tip for the parents: they don't have to give them the card.
Oh, that's good.
They don't have to give them the card. They can literally just add them as an authorized user, keep the card, let them actually ride their coattails on the credit. They're not absorbing any of the kid's credit. The kid is just absorbing their credit. So it is a great way to boost. Now, one thing that I will say, if all you have on your credit report is authorized user accounts, the underwriter can say that they won't use that credit score. So you want to make sure you establish your own credit as well.
Okay, so if you have 3 different bureaus that will report your credit score, you can have, the secured credit card, the authorized user, and that combination will help their overall credit score.
Absolutely. And if they don't have a rent, let's just say they're still living at home with mom and dad. If they don't have any rent or anything like that, they can absolutely just have those 2 lines of credit. And as long as they have those 2 lines of credit for 6 to 12 months, as soon as that score starts to boost and they have some history behind that, then they can qualify for a mortgage.
Okay, great. Let's talk about debt to income ratios.
Yes. So there are actually 2, not just 1. So you have your housing debt to income ratio and your total debt to income ratio. What we go off of is monthly. A lot of people think that it's your total debt. It's not your total debt. It's your monthly outgoing versus your monthly incoming. Okay, so everything is figured on a monthly basis. You want to make sure that your housing ratio typically is somewhere between 28 and 32% on your housing ratio. And depending on the loan program that you qualify for, You can go up to, say, 45% on the back end total, 50%, and then FHA actually allows you to go up to 55, 56% on your total debt ratio. So those are things that you want to make sure and look at. Total debt ratio, housing ratio. Sometimes if that housing ratio gets too high, even if you don't have any debt, you can't get that to push any higher. Does that make sense?
Mm-hmm. Okay.
But the higher your credit score, the more lenient they are on the ratios.
Oh, because you have a track record.
A track record of making those payments.
Great. You mentioned FHA. So what are some loan options? Do you want to speak a little briefly about that?
Yes. So there's so many, right? There is FHA, USDA, VA, conventional, and then there are also some what we call non-QM or kind of portfolio type loans. If you have someone that's self-employed, things like that, you can actually do some things that don't necessarily fit inside the box, but we can actually look at people who have been self-employed 2 years but don't have 2 years tax returns. Somebody who went from W-2 in the same field or to 1099, but they're in the same field less than 2 years, we can possibly do a 1099 or a P&L. There's tons of different fun things that we can do, but there are a lot of different options.
Okay, great. You know what? Help us understand what is considered a credit-worthy or an acceptable credit score.
Okay, so it's going to depend on which program that you're going to go to, right? Conventional requires a minimum of 620 on all of their products, 620 credit score. FHA, you could actually go down to 580 or even below 580 depending on your down payment.
Oh, wow.
So let's just say, for instance, somebody went through a rough time. They own their own home. They have a lower credit score, but they want to sell their current home and buy something else. If they're below a 600, they have some equity in their home, and they want to qualify for another home. I literally did someone with a 530 credit score, 15% down going FHA. So it can be done. It just depends on the situation, how long they've had their credit, what's on their credit, if they have bankruptcies, things like that. So conventional, hard stop at 620. But FHA, it's going to depend on down payment, if it's their own funds, if it's gift funds, or down payment assistance. Down payment assistance does require a 620 score.
What is your opinion of down payment assistance? I hear some people think it's great. Some think it's a tough hill to climb. What do you think about down payment assistance?
You know, I think it depends on the situation. I think it depends on the borrower, and it also depends on the type of assistance that you're getting. So if someone qualifies for a conventional loan and they are a first-time home buyer and they have below 80% median income, there is actually a $6,500 grant. It's not something that has to be paid back, and it doesn't affect the interest rate. It's a great program. That one is really good. The bonds through the state and the funded ones through the federal government, things like that, the more assistance you need, the higher the interest rate is. It does make it harder to qualify because the interest rate's higher, going to make your payment higher, you're going to qualify for less. But if that's the only way to get in a house, right now is the best time to buy before this market really takes off. And if it gets you into the house, and we know that appreciation is going to continue to increase, getting in with a lower price on the house is actually better than you can refinance later.
Right. Speaking of refinance, because this has been a hot topic.
Yes.
Refinance is not free. So even though you have the option to refinance if and when the interest rates drop enough, talk to people so they really understand what that means financially to them when they decide to refinance. Because some people feel like I can buy the home today at 7%, and in the fall I'll refinance if it goes down to 5%. Can they? Yes, but there is some costs that go along with refinancing.
There is. What is really, really awesome though, and what most people don't understand, the cost to refinance, you on your title policies and your title fees, you get a 60% discount if you refinance within the first 5 years of owning the home. So that makes your title fees really, really low. If, depending on credit score, the type of loan that you're doing, if you're doing a conventional loan, you can also possibly get an appraisal waiver, so you may not need an appraisal. we're also running a program right now, Buy Now, Refi Later, where we're waiving $1,500 of lender fees. So really, the only cost is your 40% on your title fees, your escrow account if you are escrowing, and potentially an appraisal. It makes it very, very affordable. So a lot of people don't realize that as well. Now, it takes a couple of years for you to refi. It's possible also, if you put 5 or 10% down, you may appreciating enough to be able to remove the PMI. So you're going to get a double whammy on the benefits, removing your PMI and reducing your rate.
That is great.
Yeah.
Because the PMI will last for the entirety of the loan until you do refinance it.
On FHA, yes. On conventional, once you reach 20% equity, it does fall off.
Okay. And that's one thing that's good to hear, because some people have owned their home for a very long time. It used to be, correct me if I'm wrong, but it used to be where even with FHA, it would roll off once you hit the 20% mark. But that's not the case anymore.
No, that changed, but it did change, and now it is for the life of the loan. So for FHA, it is for the life of the loan until you refinance out of it or sell it.
Right. Oh, another myth that if you're listening to a parent or someone who hasn't bought a home in a while, that conventional, you need 20% down. Even I know that's not the case anymore.
That is correct. If you're a first-time home buyer, on conventional, you can do as little as 3% down.
Now that is something that, surprisingly, not many people know it. Because let's say you are a first-time buyer and your parents are helping you and they have that thought that you need 20% down for conventional. But your parents are not the mortgage experts, so they may not be up to date with what is happening now that's beneficial to you. So that's why it's so critically important to connect with a lender who actually not just has a license to lend money and the mortgage license, but one that really understands the heartbeat of our local market.
Absolutely.
Well, in case you're wondering, what is this 2-1 buy down that you've been hearing about? Because it's become more and more popular in conversations related to interest rates. So this is your quick explanation. During a 2-1 buy down, what you have done is negotiated lowering your interest rates by 2 points and 1 point. Let's say, for example, you've gone to your lender, you've gotten pre-approved, and the mortgage rate that you've been quoted is 7%. Where during your first year, you will take off 2% from that 7%. So your first year, rather than it being 7% minus 2 is 5%. So your interest rate is now 5% during your first year. Now, what happens to year number 2? It changes. It actually would go up 1% because think about it, 2-1 buy down. Now the second year is 1% off of your original interest rate, which was 7%. So in that second year, your interest rate is now 6%. Now, during that third year, now this is the critical point. It is going to go back to your original mortgage rate of 7% unless you refinance. And we would like to assume that after year 2, that your interest rates or the interest rates across the board have lowered enough to where it makes sense for you to refinance to that lower rate. So just beware that in the third year, either it's going to revert back to your original 7% or you have that option to refinance for the lower rate. Now that you have a basic understanding of what the 2-1 buy down means, well, let's take a look at what this would mean to you on a practical standpoint for your monthly payments. Well, let's say, for example, you've been pre-approved from your lender to purchase a home at $450,000. So the 7% is the interest rate that you were quoted. 7% of $450,000, your principal plus interest, your monthly payment is $2,993.86. But hold on, remember, we negotiated a 2-1 buy down. So that means during your first year, instead of it being 7%, your interest rate is now 5%. So based on that, your monthly payment is $2,416. Now that's about a $577.86 a month of savings from the 7% down to the 5%. So we're looking at about a $7,000 a year based on that 5% money saved. Now remember, the second year is going to bump up to 6%. So rather than it being at $2,993.86, which is at 7%, now it's at 6%, which brings that cost down to $2,697.98. So we're looking now
at about a $295.88 savings per month, which is about a $3,500 savings per year, almost $3,600 per year. And that's a lot of savings if you're able to negotiate your 2-1 buy down. And by year 3, remember, it's going to go back up to 7% unless you refinance at a lower rate.
Well, I've got a few more questions. Speaking of the cost, we know that you need a 3.5% FHA. Depends on what type of conventional loan. You just said as low as 3%. It could be 20%. Speak to us about what the overall price is for a loan, including like closing costs.
So if you're paying your own closing cost on top of your down payment, let's just say it's an FHA loan, okay? And let's say you're putting your 3.5% down on a $350,000 loan. Typically in that price range, and some of your fees are fixed fees. So the lower the sales price, the higher the percentage for your closing cost. I would say in that $300 to $350 range, you're going to run at right around 3% on your closing cost as well, if you pay 100% of your closing cost. But right now, in today's market, because the sellers are really interested in helping move that property just as fast as we possibly can, I'm seeing them do seller concessions to help with that closing cost. So in that $400 to $450, you may see 2.5% on closing cost, things like that. It just depends on what they're wanting to do. If they are buying down the rate, doing discount points, temporary buy downs, things like that.
All right, gift loans. Everybody loves a gift.
Everybody loves a gift. So on all loan programs, the parents, relatives, it's usually immediate family, grandparents, parents, aunts and uncles, things like that. They can do 100% gift for down payment and closing costs.
Wow. So the actual borrower, what are they on the hook for?
Earnest money, appraisal, and option fees.
Okay, so earnest money is typically 1% of the loan. Option, we try to give as much as we can. We'll discuss that later. But just trust me, if you can get a gift for your closing and your down payment, I'm almost speechless. That is a huge game changer for you. You need to go ahead and call me now. Let's go find your next place. Okay, so we just have a few more things. So really, the things that you've discussed, it does cover some of our more seasoned purchasers, because if they thought 20% down for conventional, then maybe they're not getting the home they're wanting. Maybe they're waiting. And the other thing, if you've owned a home for so many years, you have a lot of equity that you can pull out of that home to use towards your down payment. So what suggestion, advice, or tips would you give to someone who's owned their home a while, but now they're ready to move to the next place?
All right, so if you are owning your own home and you've got a lot of equity, I would say there are a few different things that you can do. If you're nervous about having a really low interest rate and you're wanting to upsize, or affordability is an issue with today's interest rates, one of the things that I do with being a certified mortgage advisor is we're going to look at affordability and cash flow. Let's just say, for instance, they have a car payment, some student loans, some credit card debt. Everybody's wrapped up in credit card debt right now. We will take, and they've got 30% equity, right? They got 30% equity to put down on something else. You don't want to put that whole 30% down. Let's look at affordability and what their monthly outgoing is. Open up cash flow so that they can afford that dream home.
And 401k, how does that play a role in my ability to purchase a home?
Well, here's what I love about 401k. There's two different ways that you can borrow against it or pull money from it. You can do a hardship loan or a hardship withdrawal, which is just a 10% penalty. There's no taxes on it, right? It's a 10% penalty for a hardship withdrawal for the purchase of a primary home. My favorite one, though, however, is a loan where you pay yourself back pre-tax. So if you're paying yourself back, you don't lose ground in your 401k, and we don't count it in the DTI because you're paying yourself back.
Oh, wow.
So it's kind of a win-win.
It is a win-win.
Yeah.
Maybe I should start taking a few notes here. When we're in a competitive environment, I've had some people who have gotten their pre-approval letter, and I will call up the lender and ask, how quickly can we close this deal? We're in a competitive situation. 45 days is not going to cut it in our market. 30 days today feels like a long time to a seller. So if someone has got a pre-approved letter from you, how quickly can we close?
I can actually do 14 days. What I do is I do a full application, get all of their income and asset documents. Once I have all of that, I'll sit down and do a full consultation with them, explain everything. I can send them all the way through underwriting without them having a property, get them fully approved, offer a $2,000 guarantee to the seller that I have them fully vetted, and then all we have to do is property docs.
That sounds good to me.
And I usually get that done with the initial approval. I can get that done within 24 hours of receiving all the documents.
That sounds great. Deanna, thank you for joining me today and helping those consumers out there, the people are ready to make their next move, buy or sell. I'm Tracy Sorrell with the DFW Life, and I help people sell and buy their next home almost every day in our Dallas-Fort Worth Metroplex. And together, Deanna and I want to help you realize which plan, which financial plan, which type of loan, and some ideas that have inspired you to realize that you can purchase your next home, your place that you want to create your memories and call home.